So, Jon, you work with JRW Investments. You guys strategically advise on Delaware Statutory Trust, DSTs, 1031 exchanges, on strategic real estate wealth investing. But a lot of times I talk to clients, I'm in real estate planning. I help people think through how to sell their real estate portfolios or what to keep, what not to keep. People are always asking me about DSTs and about 1031 exchanges, and they've got a lot of questions. So I thought I could ask you a number of questions about them and even maybe get into the nitty gritty. And you could, being the educator that you are, give us a bunch of insight into, well, are DSTs the right investment? Who do they make sense for? What are they? What are 1031s, et cetera? Give us just the 30-second version of what you do and who you are.
Absolutely. Thanks, Matt, for having me. I appreciate it. It's always fun to talk to your audience through this format. Really simply, the DST is an ownership structure, right? Many of your investors, they may own property in an LLC, right? The DST is the ownership structure by which investors can take title to a property fractionally. And the typical DST is a large, stabilized, conservative, institutional blue chip property that could be a $25 million property, a $50 million property, or a $500 million property, right? That's already acquired, that's in inventory, and that investors can buy in pieces and parts relative to their exchange needs. And 99% of the time, the investor who acquires this type of product is in a 1031 exchange.
So someone could buy into these without doing a 1031 exchange?
That the sponsors that are selling their equity, they'd take any money that's green. But the primary investor who's attracted to these types of extremely stable, conservative, the DST market normalizes around cash flow. And so most of my clients they built wealth portfolios, they bought much more risky assets than what you'll see in a DST. And so they're focused on consistent monthly cash flow and protection of capital because it is a tax advantage tool more than a growth on speculative, hopeful type of real estate project.
So in the majority of cases, someone has owned real estate of maybe different kinds of real estate. It doesn't really matter what kind. They've maybe held it for a number of years, sometimes even 30, 40, 50, and they're no longer getting depreciation. They would have a big tax bill if they were to sell it and sell it traditionally. And they decide to use the IRS tax code, Section 1031, which allows them to transfer into like-kind property, real estate to real estate, and they're moving into a different type of real estate that just happens to be owned in what's called a Delaware Statutory Trust. And this specific these properties that they might be buying into tend to be, you said, very stable, tend to be very big projects, commercial sort of projects. What kinds of tenants, what kinds of properties are inside these DSTs that they're potentially 1031 exchanging their money into?
Yeah, good question. So the industry today, this may or may not be surprising for you to hear or for your audience, but there's 59 different sponsors, they're called institutional real estate companies, that are currently participating in today's market. And where today is April 2026, okay? So 59 different companies have brought to market 101 different DST investments. That's the entirety of the market. That may sound like way more than you thought, but likely it's way less than you thought. And so by the time that one of those DST investments is on the market, quote unquote, that sponsor has already purchased the property, they're operating the property has cash flow that it's producing, and that sponsor actually owns that property 100%. So they're selling interests in incremental pieces and parts to investors out from under their own ownership. The typical investor, as you said, is a real estate investor who has highly appreciated real estate. And so they have a tax problem. Okay, that's like the number one question that I ask the investor to try to understand is, what is the implication of your tax problem? Because if there's no tax problem, then we can just simply sell the property and take material receipt of the cash and walk away, right? A lot of investors, if I ask them the question, how many of you would sell tomorrow or list tomorrow if you had no capital gain implication? A large majority of my clients would list tomorrow if they didn't have the capital gain. So the 1031 exchange has been around for a long time as the tool to navigate the tax problem that they have. And the DST ownership structure qualifies for that 1031 exchange because the ownership piece is disregarded. It's really the property itself that you own fractionally that goes on your ID sheet. And so that helps investors avoid or defer the capital gain on that transaction.
Okay, so if somebody does a 1031 exchange or they meet with you, they decide they're going to do a DST, how do you help them select which DST? You've got 101 options. How do they pick which one to go into?
Yeah, I mean, we spend a lot of time answering that question every day. we talk about this framework for how we navigate the DST market. So the first thing that we want to understand about the investor, right? Because we're looking for a fit. Like if you go to our website or you hear me speak, like the purpose of JRW is to source real estate investments that are appropriate for individual investors through a disciplined due diligence lens. Okay, so we source, it needs to be specific to an investor, and it needs to be through a disciplined due diligence lens. We are every day, we've got a due diligence committee that's larger than our advisory committee, our registered representative group that serves clients directly. We have more due diligence folks than we have representatives. And so every week we're getting a new opportunity that hits our desk. Likely it's not quite yet formed as a DST. The sponsor is currently forming the investment structure, but we get the due diligence package and we're looking at the price of the property to the investor, which includes all the fees, right? We're looking at the location, the tenant, all of the demographic information. We're looking at the potential exit strategy. How does this property do under stress? What is the revenue model? What are the expenses? And what could change throughout the hold period of that property? And for any investor who hasn't had experience with commercial property, they're going to want to participate in one of JRW's due diligence seminars where they take advantage of and understand, like they'll get a bird's eye view of how one of these DSTs is formed and what we care about inside of each DST. And so how we navigate the market for investors is first we have to know the investor, then we have to know the entire market, and then we can find that fit between the investor and the market. And remember, I said there's 100 of them today. I think we're highly, highly confident generally about 7 or 8 of those 100. And when I'm talking to a client, I'm probably not going to recommend more than 3 for any individual client because of the nuances of the client and the specific deal that we've approved.
So somebody decides they would sell their property if they didn't have to pay tax. They learn about 1031 exchanges. They decide that DST makes sense for them. They meet with you and they find out which of the 3 or 4 or 7 of the 100 that makes sense for them to potentially invest in. And they decide they're going to sell their property and move that money into a new real estate investment where they own part of a much bigger commercial project. And in owning this DST, what are the benefits of it? So they owned their property wholly and they were maybe getting some cash flow. They had to do some management. What are the benefits now of owning this DST or owning part of it?
Yeah. So the benefits, I think, are what attract people to this concept in general. So most of your audience have heard of these. I'll run through them, but we should also talk about the considerations and the downsides. I spend a lot more time thinking about that on behalf of my clients than the benefits, but you get cash flow. Typically it's monthly cash flow and it starts on the day that you invest. These properties are stabilized already and they're currently owned. So we're not going and sourcing something with your cash. What we're sourcing are in place, in inventory, for sale interests of real estate. Another benefit is the diversification potential. Most of my clients, they own a specific geographic location or a specific asset class within their personal portfolio. For instance, like all single family homes in Southern California, or all like one big commercial property in Texas. So the opportunity to take that concentration of strategy and say, okay, now I want to acquire a little bit of a $100 million multifamily apartment building, or a slice of this Amazon distribution center, or a $150,000 interest in a $60 million student housing multifamily apartment building. That's the diversification by asset class. You could also say, like the 3 I just mentioned, I want to take my $1 million exchange or my $300,000 exchange and chop it up into 3 different pieces. So now I've diversified across all 3 of those with one exchange, as well as, out of my local area. Another benefit, I think the due diligence potential in the DST market is like a big benefit. You've probably worked with investors who you bring them a property locally and they have to make a decision like right now, like, are we going to do this or are we not? It's competitive. And the DST allows my team months to review a property prior to it even being formed as a DST. And so we know exactly what we're buying. And we have had the luxury of time as a due diligence wealth management office to know with high confidence whether we're going to participate or not. Most of the investors who come to me for the first time are drawn to the benefit of passive income. The DST is truly the only structure that you can invest in through 1031 exchange, they give you complete passivity. You get a mailbox check every month and you make no management decisions and you experience none of the management burdens. Another one is timing. So I can close on a DST in a week, right? So because it's already in place, if we have your account on file and we have all the necessary ownership information, we can help you subscribe to a investment in 5 business days pretty comfortably. So that takes that 45-day concern completely away. All the rest of it is pretty much real estate, right? So the tax deductions, the stepped up cost basis, the income is Schedule E, ordinary, rental income. You have limited liability. There's nothing that can happen in that project that would kind of come after your balance sheet. If there is debt in the project, it's non-recourse. So that means the property is the only collateral. My investors are not signing for or applying for the debt and the DST. That's probably the majority of the benefits that people are looking for. It's a passive income investment primarily.
And so when you say passive income, I assume you mean mostly that it's got cash flow. So what does cash flow look like, or how do they distribute cash?
Yeah, so cash flow, you own a percentage of that property, so you are the economic beneficiary of the property's economics. So the appreciation is yours fractionally. If the property goes down in value, you're on the hook for that, right? It's an investment that carries that same risk if you owned 100% of it or 1% of it. The same goes for the income. Your income is determined by the gross revenue less all of the expenses, and that difference, that NOI difference, is distributed to investors fractionally based on their ownership percentage. Typically, it's monthly income. And from an amount standpoint, in today's market, you'll see something anywhere between 4 and 6% of the equity investment is the profitable distribution of the income that investors can expect. So for a $100,000 investment, a $4,000 to $6,000 net profit income is something that they can expect.
Okay, great. And you said it goes on the Schedule E for tax reporting. So it's like you own a rental property. Are they sending you a 1099 and then that money is what your CPA puts on? How does the tax reporting work?
Yeah. So typically it's a 1099 or it's a grantor letter that shows the gross income, right? The gross income is the top part of your Schedule E on your tax return. That's not what has been distributed to you. That's what the property's generated. And then they'll provide you with a P&L that shows the individual expenses that are attributed to your ownership percentage. You'll calculate your own depreciation with your CPA based on your unique tax basis that you brought with you into the investment. And then, that bottom number is your net income number that you're paying tax on. So you get a custom P&L for your percentage of ownership.
And if you're moving into a new property, now you're getting new depreciation that maybe you didn't get previously. Right?
Yeah, that's exactly right. Yeah.
Now, obviously, a lot of times people are choosing this because they are retiree investors. They're ready to start preparing their estate and making their assets passive, easier, but also prepared for the next generation. How's DST handled when it comes to estate planning and preparing for, okay, we actually want things that are easier to transfer to the next generation?
Yeah. So I'll tell this as kind of a narrative. Let's assume there's an investor with 2 investment properties. They're both worth $500,000. Okay. And as happens often, the investor's working with me and we identify like one of these properties is definitely the first one they want to sell. So they go through the process. They sell this property traditionally, right, through their local trusted agent or broker. They open up the qualified intermediary account and they select through my office a DST that's suitable for their goals and objectives. Okay, so now what does this investor have? They got $500,000 worth of this property that's structured as a DST, and they still have this $500,000 home or investment property that they've owned traditionally. Now, in this hypothetical narrative, this investor passes away. And let's talk about what happens with his portfolio. The DST investment is automatically, let's assume that the investor has 3 children. The DST investment is automatically divided amongst the 3 beneficiaries and assigned individually and independently to all 3 of those beneficiaries. Those 3 beneficiaries get a stepped up tax basis, and they all 3, working with me, receive individual monthly checks of 1/3 of what dad was getting, right? So what have we done? We've completely created an independent on these 3 children, and they're now continuing to participate in the same passive income investment that dad selected with our office and went through our guidance. A typical DST runs for 5 to 7 years prior to it being listed for sale, the property listed for sale by the sponsor. And when that property is listed for sale, those three children will receive individually and independently their pro rata share of the proceeds of the sale. Okay, so that's the DST side. No tax implication, right? Because the stepped up basis, they take the cash, they do whatever they want. And maybe they have very different goals. Now, what happens with this other $500,000 property over here? Well, that trust that directed the investment to the three beneficiaries went from a living trust to an irrevocable trust. That irrevocable trust effectively is a tax-paying entity. It's like a business. And those three beneficial heirs are business partners now in managing the assets in this trust. And so now these three children are codependent on one another, making decisions on behalf of one another. For do we sell the property? Do we refinance the property? Do we change out the tenant? Okay, there's an expense. Who pays for that? Who's kicking in cash for that expense? They're business partners as a part of this overall thing. Same stepped up basis, and they can sell that property, but they have this added layer of codependence, whereas the DST provides this benefit of independence from one another through the beneficiaries.
I mean, it's a great way to explain it. And I tell people all the time in my role that the owning those properties together, that codependent relationship among siblings often does not go well, right? And sometimes you can already foresee that as a parent looking at your children. You realize, well, they're not going to necessarily get along very well in managing these things together. But sometimes you think they might get along, and they still struggle after. I mean, so much sibling pain comes from dealing with estate issues after mom or dad has passed. And I think you hit the nail on the head. The DST is an immediate separation, and you've got that ease. And then when the property goes to sell, they each get their distribution with no capital gains tax implications with a stepped up basis.
Most of my clients didn't inherit anything. They created it all themselves. And so they have never seen how this happens, right? They didn't inherit it from their parents. And they probably don't have a plan. So they need to speak with somebody like you or somebody like me who has seen this happen many, many times on behalf of our clients to really think strategically about that. The clients I have who have inherited something, most of them have a painful story around how that went. So it's a good conversation to have with someone like you.
And then, are there any fees associated with the DST investment? How does the sponsor get extra money? How does that work?
Yeah, it's a for-profit industry. So there's three parties that are kind of involved outside of the investor in managing and brokering and facilitating this entire investment. So it's the sponsor company is one. That sponsor company is the institutional real estate company that they're the ones who went out and sourced the property from the street. They've acquired the property with their capital. They've created the inventory, and they're selling it out to an investor. They also are responsible to put the property manager in place, and they're also responsible to sell the property on the back end. Okay, so that's the first party. The second party is the property manager. So oftentimes it's a best-in-class local property manager for that asset class. If it's an apartment building, you'll recognize the name of the 300-unit apartment building. You'll recognize the name of the property manager because they likely manage other properties locally. And they take a percentage of the income, just like you would expect. If you owned the property yourself, you'd hire that same manager. The difference being, if you own a single family home, you're probably paying 8 to 10% of gross rent to your property management group. For these larger institutional assets, it's like between 0.5% and 2.5%, maybe at the absolute max for a high management burden type of asset in the DST market. So that economies of scale, actually, that saves clients money. The third kind of person in the mix is me, right? It's the broker dealer or it's the investment advisor who is responsible for the client relationship. And that firm gets paid on the front end of the investment for placing the investor into that overall DST. The way that we talk about the fees are they're either an operational expense, which is usually an advantage in the DST to the traditional asset, or it's a organizational and offering expense, which in my opinion is a disadvantage to the investor. And I'll lean into that for a second. The disadvantage is that the sponsor had to go to the street to buy the property. And let's say they bought that property for 90 cents, okay, not 90 cents on the dollar, Then they added the acquisition, organizational, and offering expenses to that, and they're selling it to investors for $1. Okay, using my hypothetical. My biggest question, and our due diligence team finds the answer to this question, is what is the property worth? If the property is worth 90 cents, that's not a good deal for the investor, and we'll likely say no to that deal. If the property is worth $1.10, then that's a good deal. The dollar is the right price to pay. That's, you're actually buying basis on that acquisition. But what has to be true in order for us to approve a deal? The sponsor has to have some sort of an advantage on the acquisition that they're buying below market. So they have to be well capitalized or well networked. There has to be some unique asynchronous opportunity that came to them that allows them to stack fees on top of a deal that still creates an accretive acquisition for our client. So that's kind of the industry question that no one is asking. Like, if I'm paying this price, what's it worth? And that's a great question for your audience to ask people like me.
I love that. I love that. As we wrap this up, one other question I often hear is, well, if I own my property, I need a 1031 exchange, but I still have a mortgage on the property, does the DST still work for me?
Yeah, great question. About half of the DST market today carries a loan as a part of the investment structure. And so what that means is that that sponsor company, they acquired a property, let's call it a $50 million property. Okay. They acquire that property from a broker, right? Competitive or non-competitive process. They buy it for 50 million. They structure the trust, they structure the investment, and they go to a traditional bank and they get a CMBS loan of $25 million. And that 25 million gets layered into the investment structure. And now we have this fully syndicated $50 million property where the sponsor is raising 25 million from investors, and they already have a $25 million loan in place. And what that means is that for every fractional interest that investor buys, half of it will be debt and half of it will be equity. And so you can consider the 1031 exchange proceeds as a down payment, right? You can bring $200,000 worth of proceeds into this offering, and you'll close on $400,000 worth of the value of that property and own $400,000 of that $50 million offering. So you want to understand that the debt in your current portfolio, right? Because you want to have a plan for how to manage that debt going forward. The debt in the DST is non-recourse. So you can never be upside down. You can never, owe more than it's worth, quote unquote. And it can never, the limited liability of the DST, you can never lose on balance sheet assets if you have a problem with the property in the DST.
That's great. Is there anything else that if someone's exploring this idea of DST that they need to know or understand? What else?
Yeah.
I think we hit on a lot of those pieces. Is there anything we missed?
One big one that we haven't hit on is that about 5 years ago, Wall Street got very, very involved in this problem that we've been discussing. This retiree investor who doesn't have a solution for the real estate portion of their portfolio. And major alternative investment organizations that you'll have heard of through other investments like infrastructure or private credit or real estate have created DSTs that have an accelerated and an intentional path toward a REIT as an exit. And so you'll hear the terminology 721 exchange or 721 UPREIT. What this effectively enables, and we can do a whole nother podcast on this, is for an investor to 1031 into a DST, where that DST's intent, the exit intent, is to be acquired by a REIT. And oftentimes that REIT is an affiliate or it's the same sponsor as the DST. So it's an intentional path where the REIT buys the entire DST, like all of the assets, and all of the investors come with that asset and roll up into the overall parent REIT that is going to be a long-term investment for those clients. And so those clients who participate in those DSTs, they do so solely because they want exposure to that real estate investment trust. Today, there are 13 of those that exist in 26. My hypothesis is that in 2028, there's going to be double that. And it's because the world is trying to solve the same problem for investors. How do we help an investor retire? The REIT as a structure is entirely different than a DST. It's not real estate anymore. It's a business. It's an operating business that operates real estate. But the returns that are being driven to investors are operating business returns. And so as such, there's a whole lot of other things that need to be evaluated prior to selecting that REIT. And again, I would encourage investors to reach out to our office, and we can educate them on the pros and cons of that strategy and the differences that exist in the market today.
And what are the paths to communicate with you or to connect with you if someone would like to maybe have a consult or find out more information? How can they connect with you and your firm?
Sure. So if you're watching this on YouTube, I'm sure Matt will put my email or link to my calendar in the description below. But my firm's name is JRW Investments, and our website is jrw.com. There's a contact form on that website. It's pretty easy to find, and you can just reach out through that contact form and ask for Jon Taylor, and I'll reach out to you. Most of my time is spent in consultation and education with clients, and so I'm happy to hop on a phone call and discuss your scenario.
Awesome. Thanks so much, Jon, for demystifying DST and some of the 1031 things. I know that this will help a lot of people understand more about this.
Thanks, Matt. Thanks for having me.
That's it for today's episode of the Wealth Transfer Podcast. If you found value in this conversation, would you leave us a review? That would be just so honoring to us. We'd appreciate it. And if you know somebody who might need to listen to this because they're thinking about their next chapter, will you send them a link to this podcast or this video so that they can listen more as well? For more episodes and expert insights, be sure to follow and subscribe. That means the most to us. Follow and subscribe, please, please, please. And when you're ready to take action on your own real estate plan, or if you need help with wealth transfer planning, we know a number of experts in all the different spaces. We'd love to connect you with them. You can reach out to us via direct message or comment. You can email us, matt@templeton.realestate. No .com, just templeton.realestate. And I'd be happy to connect you with an advisor. Thanks so much.